Finally, some good news for the markets. Now, after years of being weighed down by tariffs and a dull earnings season, relief seems to be finally within our reach. Now, picture this, that two-wheeler you've been saving up for a long time could get cheaper. Now, even that packet of ghee that you buy every month might suddenly cost less. And no, this isn't because of some festive discount sale. This is because the government can change something that touches every corner of our lives. GST. A change which can be so big, it could shift how India consumes and how industries earn. And in this video, we'll guide you through what has happened and how it will impact the markets. First up, let's see what's happening. Right now, India's GST works like a ladder. 4 steps: 5%, 12%, 18%, and 28%. Now, essentials usually fall in the 5% or the 12% bracket, while consumer durables and vehicles sit on the 28% slab. On top of that, goods like tobacco and aerated drinks carry an extra cess. But under the new proposal called GST 2.0, this ladder is getting cut to just 2 steps. Only 5% and 18% will remain. Everyday essentials like food and footwear will slide into the lower 5% bracket. Most consumer goods will settle at 18%. Earlier, the 12% bracket carried a lot of middle-class items: packaged food, textiles, footwear, and even sweets. All of those moved down to the 5%. At the other end, things like scooters and entry-level cars, TVs and ACs, earlier taxed at 28%, fall down to 18%. So, unlike before, where GST was scattered across 4 levels, we're now looking at just 2 main buckets. So, what does this mean for you and me? First up, consumption gets a direct boost. Now, ICICI Bank research estimates that this change could free up about 1.4 lakh crore rupees in the economy. That's nearly 0.4% of India's GDP. An SBI report goes even further, saying that consumption could rise by almost 2 lakh crore rupees. That's about 0.6% of India's GDP. Secondly, inflation cools off. Now, with food, FMCG and consumer items getting cheaper, overall inflation could dip by 20 to 50 basis points. That's not just good for households, but also good for RBI's growth versus inflation balancing act. Plus, this is a second tax cut in a year. Earlier in the budget this year, the starting income tax slab was moved to 12.75 lakh rupees. The government might be taking these steps to fight against the slowdown in the economy. How does this impact sectors? Let's start with autos, one of the biggest winners in this move. Now, two-wheelers and entry-level cars will now move from 28% GST slab to 18%. That's a 10% point cut in taxes. Analysts at Nomura are saying that this could drive a 5 to 10% demand upside in the sector. Now, for small cars, the price cut works out to be about 8% lower, and for bigger cars, they could see a 3 to 5% reduction. And here's where it all gets interesting. Companies like Maruti Suzuki, which heavily depend on small cars, could benefit the most. But there's a catch. Motorcycles above 350cc might actually face higher GST, rising from 31% to 40%. That squeezes the premium bike segment. Next up, consumer durables. Think about your ACs, your fridges, and your air conditioners. All of these are dropping from 28% GST to 18%. Now, for the middle-class household, this could finally mean buying that air conditioner that they've been postponing. In fact, Economic Times is reporting that this will cut AC prices from 1,500 rupees to 2,500 rupees, depending on the model that you're picking. Industry players like Panasonic are saying that this is phenomenal because GST applied on the base price. So a 10% slab cut actually leads to a 6 to 7 final price drop for consumers. This could be great news for the consumer durable sector, as the recent quarters, haven't been necessarily very good for them. Cements. Cement is another sector that's just lighting up. Right now, it's taxed at 28%, but under the rejig, that could move down to 18%. Now, the folks at ICICI Securities are estimating that every 1% fall in realization could boost the EBITDA by 3 to 5% across the industry. That's why you're seeing cement stocks already rallying. Now, Money Control is reporting that if this reform goes through, the momentum could take the sector into even higher gear, especially with companies like Ultratech, which is already positioned to benefit. Now, let's talk about FMCG, fast-moving consumer goods. Now, FMCG is where the impact hits daily life. Now, your items like ghee, butter, namkeen, sweets and pickles are sliding down from the 12% bracket to the 5% bracket. Now, the Nifty FMCG index jumped 4% in just 3 days once this news broke. Some of the biggest FMCG companies like Bikaji, Imami, Dabur and Nestle, which have 25 to 70% of their business in this 12% category, will see a direct lift as it makes their products even more affordable. Well, in short, this is a volume game. You have cheaper prices means faster consumption growth in both rural and urban India. And finally, footwear. Earlier, footwear above 1,000 rupees was taxed at 12%. And now, it's just 5%. And for India's labor-heavy textile and footwear industry, this is a huge relief. Now, Bata's CEO pointed out that when the rate was raised from 5% to 12% a few years ago, the volumes in the sub-1,000 rupee category, which makes up about 80 to 85% of the industry, dropped sharply. And now, with the cut back to 5%, the sector is, well, poised for very strong recovery, especially in the mass market segment. So, these are the few sectors which might benefit from this change. But what about the government's revenue? Well, cutting taxes sounds risky, right? After all, GST collections are the backbone of state and central revenue. But here's the interesting part. The government estimates a revenue shortfall of about 85,000 crores annually. But as we saw before the change, this might boost demand by 2 lakh crore rupees or 0.6% of the GDP, which is double the losses. In other words, the government loses in rate what it hopes to make up in volume. So here's the bottom line. India is moving away from a complicated 4-slab GST system to a very simple 2-slab system. Essentials get cheaper, auto, FMCG, textile and consumer durables really stand to benefit, and luxury and other goods take a hit. For the markets, this rejig means a rally in consumption-driven stocks. Autos, FMCG, consumer durables, while tobacco and liquor might see some pressure. But at the heart of it, this is more than a tax change. It's a signal. India wants to put more money in the hands of consumers and let demand drive the next leg of growth. What are your thoughts? Let us know in the comments below.